This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perney, and today on the download, we have markets kind of going a little bit better directions than we have in past weeks. We have some good news on a few geopolitical fronts, so let's get into it. We have the Dow future surging nearly 400 points as Russia says they are removing some troops from the Ukrainian border, which is a fantastic news on the subject besides just the implications of what that means for the markets. The rising tensions between Russia, Ukraine, and the broader world in general have been something that have been closely watched by everyone really in the world, and specifically investors looking really towards what it means primarily in the energy sector, as this area of the world is a large exporter of natural gas and petroleum products. So seeing that some of the indications that are going towards a de-escalation of some of these tensions is fantastic news on many fronts, hoping that the world can kind of get on a better footing, and hopefully there is no bloodshed, and also that the securities markets aren't going to be rocked as much as previously thought with these things going on. On tech news, we have Intel reaching a $5.4 billion deal to buy Tower Semiconductors, a large manufacturer of different printed circuit board microconductors that is falling right in line with larger acquisitions such as Sony's purchase of the intellectual property of Bungie and Microsoft's purchase of Activision, marking a very busy first quarter of 2022 for acquisitions of companies that are going around. We're still seeing some languishing on the telecommunications front, with some large purchases of companies being held up by the Department of Justice, but we shall see what happens in that sector, as there are some big deals left on the table on other sectors when it comes to mergers and acquisitions. We're seeing Virgin Galactic spaceflight company, the arm of Virgin owned by Richard Branson, that has dealt with low Earth orbit travel for wealthy consumers, jumping significantly after reservations have spiked for the $450,000 reservations that have been going on with that company. The company seeing a 12.75% jump in their share price after trading on Monday. Now, things with COVID, as we always have to do, at least touch on that a slight bit, are going in a few different mixed directions. We're still seeing very high inflation figures, specifically when looking at the consumer pricing index. Now, some of these inflation numbers are being driven by a number of different factors besides just COVID. We have the large protests going on in Canada with truck drivers, which are hemming up manufacturing goods, which are driving some costs higher in the United States. But we are seeing that some of these things are calming down a bit. But the US inflation factors that were such a concern back in the 80s, we still have not met some of those metrics. Now, we are seeing some mandates for COVID being leaned up on, however, some good, some maybe not so good. Walmart is ending their mask mandate requirement for vaccinated workers, and paid COVID leave is expected to follow shortly thereafter. We have the Olympics still going on, with a slight bit of controversy regarding Russian figure skating and doping allegations, although not necessarily something that is directly affecting financial markets. Definitely still something interesting to look out for. So to look forward in the week, hopefully we will see a continued resurgence with the futures trading continuing to trade high, which will have a better implication for present value stock trading, and the rest of the markets hopefully continuing to go in a similar fashion. Now, one last item that I will speak on, a lot of interest has been coming up in the recent weeks and months on precious metals, and I just wanted to touch on what those values were sitting at today. We're seeing the 30-day price performance of gold up 1.82% as of the recording of this on Tuesday, February 15th. The 6-month gold is up 4.1%, and gold over the past year is up 1.8%. So some interesting things to look at. Precious metals typically always being seen as a safe haven and a good hedge on inflation when there are very specific market factors affecting price of goods and manufacturing. But overall, the price increase not being as crazy as many people have been making it out to seem, but still interesting nonetheless. This has been The Download. Today on the What is a royalty? A royalty is a legally binding payment made to an individual or company for ongoing use of their assets, including copyrighted work, franchises, and natural resources. An example of royalties would be payments received by musicians when their original songs are played on the radio or television, used in movies, performed at concerts, bars, and restaurants, or consumed via streaming services. In most cases, royalties are revenue generators specifically designed to compensate the owner of songs or property when they're licensed of their assets for another party's use. Specifically, at least in the podcast today, this will be focused on oil and gas. This has been The What Is. Welcome to another edition of the Alternative Investing Advantage podcast. My name is Alex Perney, and today we have on Jim Hiza, with H3 NRG. We're going to be talking about oil and gas royalties and how to invest in this type of investment structure. It's definitely a new class for me. I have a lot of experience in doing private equities, real estate, mortgage lending, and the like, but I always love having on new guests that can kind of give us a insight into something that is, certainly a great option for some people and some things that people haven't heard of maybe or want some more information on. So Jim, thanks for being on with us today.
Thanks, Alex.
Yeah, so give us a little bit about your background and how you kind of came to be at H3 and what your career trajectory looked like up until this point.
That's good. I started out actually out of college as a CPA, not doing taxes, but doing big bank CPA work, more analytical. Didn't really like it. Became a financial planner in the mid '90s. And had my own, ultimately ended up having my own firm for, 15 years or so. After I got my clients' money back in 08, 09, I was looking for alternative assets. And I found oil and gas royalties, which originally I'm from North Carolina where, there's no oil and gas. So I didn't know what the heck this stuff was. And went out to Texas, with a company and learned all about it and just thought it was the best asset I'd ever seen. Subsequently, the following year in 2010, sold my practice to start managing these assets for hedge funds and endowments and foundations. A couple of different shops after the price crashes in 2015, oil price crashes, and connected with my partners now a couple of years ago.
Awesome, great. So what kind of sector does H3 focus on?
So we only do oil and gas royalties. We don't do working interest or drilling. And within the royalty space, we only deal with producing royalties, which we'll get into in a few minutes. So we stay, in other words, we stay on the conservative end of the pool. We don't get into the risky stuff.
Gotcha, great. So, the first thing I want to start off by asking you is, what are oil and gas royalties?
That's a good question. So you'll hear the two terms thrown around a lot in this space. You'll hear minerals and you hear royalties. And let me just take a few minutes to explain the difference. So minerals are the subsurface deeded title real estate. So if you think about, a large ranch in Texas, everything below the surface is technically minerals. If when the oil and gas company says, hey, I want to drill a well on this ranch, they negotiate with the mineral rights owners not the surface right owner. The mineral rights owners have, they get to make the decision whether or not they sign a lease with the oil and gas company, not the surface right owner. Now, having said that, once they negotiate that lease, there'll be a royalty percentage paid to the mineral owners for all of the production of that well and subsequent wells. The surface owner has a couple of protections. They will get paid for the road access to the well site. They will get paid for the couple of acres for the pad. And there's rules, you can't put it so many feet from their house, et cetera. But they don't get to participate in the production of that well. They don't get a royalty, just being the surface rights owner. And this country Canada does it a little bit. We're not really familiar with Canada. I think Australia does, but other than that, we're the only country that allows individual property rights to own the minerals. Every other country is the government.
Okay, cool. So and that kind of brings up an interesting point that I'm kind of confused on is that, let's say I go out to Texas, I live in Florida and I buy 15 acres of property. Now that doesn't inherently give me rights to the minerals, right? I own what you mentioned as the surface rights, correct? If I bought that 15-acre plot of land, I would just own the surface rights, correct? In general, if just getting a regular deed.
It depends. That's a really good question. It depends because several years ago, and you can go look this up after the call, several years ago, a very large home builder in the U.S. lost a lawsuit where they were severing the mineral rights underneath the housing developments they were building, unbeknownst to the housing owners, the people buying the houses. It was not disclosed. So you may own it, you may not own it.
Gotcha. And that's essentially if someone is, maybe just getting into this, if you just want to go buy property in a state that may have rich minerals, it's something that you need to look at and have that discussion with whomever is, maybe selling the property or the realtor or the title company to see, what exactly you're buying. Because what you're saying is that it's not always a package deal. If you buy the surface dirt, you may not own, more than, 5 feet of the topsoil. And if you actually are buying that to try to make a mineral rights or gas and oil play, you need to make sure that what you're buying includes that because they might be detached from one another, correct?
Correct. However, if you're buying a home, let's say in a known geological play where there's oil and gas wells existing, it's highly unlikely you're going to get the minerals with it. When they developed the Bakken in North Dakota several years ago, when they first started developing it, there were mineral rights owners that own and surface rights owners. There were some that owned both. There were some that didn't own both. But a lot of the mineral rights owners owned a huge portion of the minerals. In West Texas and the Haynesville and East Texas and West Louisiana and up in the Marcellus and Ohio, West Virginia and Pennsylvania and out in the DJ and Colorado and Wyoming, there are thousands, if not hundreds of thousands of mineral owners. Now, at the oil and gas company, it all has to add up to 100%. But oftentimes you are seeing we're acquiring 1%, less than 2% of any the total acreage, if you will.
Okay, gotcha. So essentially what most people are looking at, if you're investing in the one oil and gas area I know is called the Permian Basin. I believe that's Texas, correct?
Yep, West Texas. Texas.
If you go buy a chunk of land out in the Permian Basin in West Texas, you're probably just buying the surface and someone else holds the mineral rights, but
most likely.
Yeah. So, but in that case, there is still a play for you to get royalties off of people that are, pulling those minerals out of the ground. And that's kind of the area that y'all operate in. Is that correct? Or do you get more into the other stuff, or is it kind of just the people that have, getting royalties and other things like that off of the topsoil that they own?
So, there's no royalties off the topsoil. That's all off the production of wells drilled and paid to the mineral rights owners. The royalty is just the percentage of the oil and gas coming out of the ground every month, and it varies by basin. Some basins are 12.5%, some are 20%. So it just depends on where you're at. But that 20% or 12.5% is for all of the mineral rights owners. It's not just for you.
Okay.
You have your percentage of the 12.5 or 20% royalty.
Gotcha. Awesome.
And so for us at H3, we actually have Our sourcing for deals is organic and direct. We only deal with the actual landowners, the sellers. We don't deal with brokers. And we have inventory, typically $20 to $30 million of deals a month, and it's all over the country.
Okay, cool. So how exactly do oil and gas rights fit into a portfolio? It's easy enough for people to say, hey, real estate should be part of your portfolio, or, securities, bonds, mutual funds, things like that. But, as far as anything I've ever experienced, saying, hey, oil and gas royalties or mineral rights, that's something that, I'm just kind of staring at a wall going, okay, great. I understand the words, but what exactly does that mean? So what kind of placement do these have in a portfolio, and what kind of, things do these return on those? Give us a little bit of insight on that.
Sure. That's a great question. So right now, the returns that we are able to deliver to investors are between 10 and 15%. And I'll get into how we calculate that in just a second. But because I want to answer your question first, how does it fit into a portfolio? This asset is a multi-generational cash flow asset. The wells typically will pay out, if you have them engineered, let's say when a well is first drilled and you get a petroleum engineer to analyze it and say, okay, how long is it going to produce? That engineering report will say 30 to 50 years. That does not include all of the organic upside, which I'll get into in a minute, but it is a multi-generational cash flowing asset. It provides income, monthly income. Whether oil prices go up or down, you're getting paid every month. So where does it fit into a portfolio? It could easily compete with bonds. It does not have the volatility of the stock market. But the downside to owning deeded title real estate is it's deeded title real estate. You can't, call your broker up or call your, go on Charles Schwab and sell it and get your money in 3 days. It's a process. You have to sell it. There are a couple of auction firms that can sell it pretty quickly, but then you're at the mercy of the highest bidder. We always have people calling us looking for this stuff, so we could probably get you out within, say, a couple of months. So it's not as liquid as your other assets. So, don't put 50% of your stuff here if you're not comfortable with that. But it certainly has a place in a portfolio it's a hard asset, so it's not correlated to the financial markets. It is income producing. It is inherently, by the nature of what it is, where the income's coming from, is inherently an inflation hedge, because most inflation is caused by energy. Certainly there's some labor that can go in there too, but it's mostly energy. So people think of food costs, but the reason the food prices go up is because the energy costs to produce the food went up.
Sure, absolutely. And it brought up kind of an interesting point that, and I'm certainly very curious about, is that the price correlation between having, like people think of, gas prices, they see, barrel of oil is at X. So how does that play into, the pricing and the royalty pricing for this? Is it always typically, or does it change? Is it just kind of a fixed rate of saying, hey, we're going to pay, X for the amount of production coming out of this? How is that kind of calculated on when you look at the cash flow? Which is, what you're indicating is kind of one of the features of this. It is a cash flowing asset. It's not necessarily something you hold for like an appreciable value play. It's more of a cash flow play. So how do those things correlate?
So where we play in the conservative space of royalties is a cash flowing asset. You can certainly buy mineral rights where there's oil and gas, but no wells. That is more of a capital gains down the road. We hope they drill a well play, but you, as a mineral rights owner, you can't call up an oil and gas company and say, hey, you need to drill my acreage. You can't do that. They won't even listen to you. So that is pure speculative, which we don't deal with. Other people do, but we don't. How a royalty check is calculated, I think will explain answer your question. So when you look at your royalty check, it is simply how much oil or gas or both did the well produce times the commodity times the commodity price. It won't be exactly the price you see on on Bloomberg, because it'll be, there's a little bit of a cost to get it to market from the well might be in the middle of nowhere. And then they get the gross amount paid. Excuse me. Sorry.
That's fine.
So then you get the gross amount paid. Then they take off a few deductions. You might have ad valorem or property taxes taken out. Depends on where you're at in the country and what operator. And you may have a few marketing fees, but it's typically the net to the royalty owners is typically 91% of the gross. So it's not a lot that comes out. And then the time multiplies by your ownership percentage. That's your check. So it's production times price times ownership percentage, essentially.
And that's paid out on a monthly basis, typically for these types of assets, correct?
Correct.
Okay, great.
Whether the oil and gas company goes bankrupt on paper, it doesn't matter. Those wells keep producing. You still keep getting paid.
Gotcha. Well, I guess that's an interesting point because there's an operator of the well, correct? So
correct.
The solvency, I guess, how does that exactly work though, of the solvency of the company that's operating the well? Because, if the person operating it doesn't manage it, I mean, how does that kind of work? You mentioned the solvency of the company doesn't matter too much. How exactly does that play out? Let's say the company, goes out of business or something. How are these things picked up, right, and how does that work exactly?
So if you have a small mom and pop operator that goes out of business, you may, those wells may go offline, but typically somebody's going to come in and buy those assets so they don't stop producing, which we hardly ever see minerals under small mom and pop, companies. We're usually dealing with the big boys and big girls too. So bigger companies, they might go bankrupt on paper. Chesapeake or EOG goes bankrupt because they racked up too much debt. The stock goes to zero, but the company keeps chugging along. Wells keep producing.
Mm-hmm. Okay, gotcha. Yeah, that's something I never really thought of because essentially you're negotiating a contract with a company to pull this stuff out of the ground. They just don't swing by and it's already packaged up nicely for them. Someone's got to
right,
suck it out of the ground and then ship it off.
Somebody's got to drill it.
Yeah. Exactly.
Yeah, so somebody's got to spend $8 million to drill it.
So what are kind of some of the, long-term effects of this? You had mentioned kind of in our outline of what we're talking about, between, things like prices, and you mentioned things like infill drilling, formations and things like that. What do some of those things mean to the investor if they're coming in? And I'm sure if someone just Google searches this, these are things they're going to see. I don't really know much about it, and I didn't do any more research because I wanted to have you kind of explain it to me so I would know how to formulate my questions. But what do some of those things mean to the investor when they're looking at, researching this and seeing what it means as far as, more of a long-term cash flow play instead of, like you mentioned, this really isn't so much of a speculation or capital gains play of the, long-term
right,
cash flow of how it fits in a portfolio?
So when we first acquire a deal, an asset, and we tell the investor, we can deliver you a 12% yield. Where do we get that number? Well, what we've done is we have taken the seller's previous, call it 2 to 6 month check stubs, averaged them, whatever was net to the seller, whatever they could go deposit in the bank, average them, multiply by 12, and divide it to the investor's investment. If they invested 100K, then that annualized monthly royalty would be 12 grand. Okay. So going forward though, how is that impacted? So you've got organic growth from multiple angles on this asset. One, commodity price. If you go on to the Energy Information Administration, which is basically a government entity, on their website and look up the average monthly oil prices, which they've got going back decades. You can go back the last 6 months and average it. You're going to come at about 75, $80. Well, we're at 90 today, right? Just about every investment bank and Wall Street bank is calling for $100 or $120 oil this year and $120 to $150 oil next year. So let's say you bought an average cash flow producing 12%, but the average oil price was only $75. And 2 years from now, the price has doubled. What does that do to your yield? It doesn't quite double it, and I'll explain why in just a minute, but it's definitely gone up significantly. So there's organic growth from the price increase, commodity price increase. The other areas of organic growth is, first and foremost, if you did like an MRI of the subsurface down to the core of the earth, in the business, it's called a 3D seismic, but it's like an MRI. And you looked at how many geological formations where there's oil and gas at different layers below the surface. The well that you've acquired is in one of those formations. In most, if not all of the formations, especially the large ones around the country, there are 5 to 10 pay zones that they can go back and drill into. Maybe this well is producing at 8,000 feet below the surface, and they can go and drill at 10,000 and 12,000 and 15,000 and 6,000 in the future, whenever they feel like it's economically feasible to do so. So there's more organic growth from there. That's number two. And then there's several others as well. So what else is, when they first start drilling the acreage that you're in, and maybe you're only in 5 acres, but they typically will pool 640 acres into what's called a unit, where they drill and then everybody gets paid accordingly, just doing the math. So let's say they start drilling a 640 acre unit and they drill the first well. Well, they might drill the second well, pretty far apart, because they certainly don't want it to interfere with the first well. And as over time, as they start to understand the geology, they have geophysicists on staff. They know it pretty well, but you don't really know it until you drill the wells and see what's happening, right? So they drill the first couple of wells pretty far apart. Once they understand the geology, they will typically go back and drill in between those wells. They would reduce the spacing between the wells. That's called infill drilling. And they figure out, okay, we can be a little closer together without the wells interfering with each other. Because what you don't want to do is have a producing well, drill the second one, and then the first one goes away because your second one messed it up, right? It starts drawing the pressure out.
Sure. And this whole concept.
So
go ahead.
Go ahead.
So the whole concept of the infill drilling is to increase production, because that's what's directly going to affect the investor's bottom line. Is the more production they have from the area that they've purchased the mineral rights or the royalties for, right, the higher the rate of return, because you talked about that multiplier. It's like what volume times the spot price minus ancillary costs,
right,
like taxes, fees, and stuff like that. So the idea is that, you're buying these.
They drill another well, you get paid.
Yeah, exactly. So you mentioned
the more wells they drill, you get paid.
Yeah.
And there's another way to actually get organic growth.
Okay.
So when they drill the first well, and you've got this well that's producing, maybe it's been online, 6 or 7 years. We know from history that, you think about when you drill a well, the pressure is extremely high when you first open that rock, right, to get the oil and gas out. And because the pressure is so high, the volume is really high. From that point forward, unless it's a vertical well, the old school way, unconventional versus horizontal fracking, where the pressure is extremely high, the production is going to drop significantly in the first 2 years. Okay, we know this. Everybody understands this, because the pressure drops, the amount of production drops, and it drops. It depends. Every well is different. Every formation is different. Oil is different from gas, but just bank on a 60, 70, 80% drop in 2 years. When we're first acquiring these things, we want to be past that. We don't want to invest in a well that was a year old and still have another 40% drop coming next year. We don't want that. We'll typically, buy these things 3 years past, but every well will go down in production. Eventually that drop in production, it curves like, it's almost like the first hill of a roller coaster. That's what it looks like. But then instead of going up again, it just levels off and it's flat. The monthly or the annual declines, you eventually get down to 6, 7, 8%. Mm-hmm. So going back to the organic growth with the price increase, it depends on where we are on that curve, right? Or did we just finish going down the first hill of the roller coaster, or are we way down the track where it's about to slow down? So if you get a double in price, production goes down 10%. You go from 12 to 24% on your yield in price. but you got to back off 10% from the production decline, you're still looking at a 22% yield from where you started.
Okay.
Which is the reason why people want to get in now, right?
Exactly. So
before oil goes to 150.
Yeah. And so y'all focus at least, and tell me a little bit about kind of one, what is the actual, we kind of talked about, the generality of saying, hey, if you invest in quote this, here's how the production versus cost and everything else works into making your return. But if someone says, hey, and we're looking more towards the indicia of what the actual investment is, what exactly are they getting? They say, okay, great. This makes sense. Yep. These wells produce, you're trying to get in after, you kind of initially pop the cork. So you kind of like buying a used car, you buy a couple of years old, you get that depreciation, it still holds its value. Eventually everything does kind of dwindle away eventually, but you want to get in when there's still good meat on that well. What exactly, when someone comes in to this and says, okay, I'd like to invest in this, what exactly are they getting? Is it some type of like private placement? Are there deeds associated with this stuff? Are they recorded on public record? Because that's a lot of stuff that we deal in is the hard assets, tangible pieces of real estate, houses, mortgages. What exactly is this stuff, and how is it, delivered to the client as far as what they're getting for their investment?
Good question, but I need to finish the drop in production real quick on the organic growth.
Sure.
So when they first drill a well, they're only going to get out about 10 to 20% of what's known to be down below the surface. There is techniques, they've been around for decades, to go back in and increase the pressure in that existing well. Not drill a new well, go into the same well and increase the pressure. Every time they do that, you get another little hill on the roller coaster, and then it goes down again. And they can do it 2 and 3 times. It's called secondary and tertiary recovery, or enhanced oil recovery, EOR for short. There's several methods of doing it. You can pump CO2 in there. You can water flood the area to make, because oil, you put water in the well, oil will rise to the top. It floats on water. There's acid ways. There's a bunch of ways they know how to go in and do that. But even with all that technology, they still only know how to get out 30 to 40% of the known resource that's down there currently. Technology will improve, obviously, in the future. We don't know when. So that's the last piece of the organic growth puzzle. Getting back to your existing question, what are they buying? What's an investor buying? It's a great question, because we are not a Reg D offering. So it's not a limited partnership. There's no fees. You get the deeded title. You get the deed to the asset or the property. How do we make money is, if somebody invests $100,000, maybe we know how to buy the asset at 85 to 90,000, and we just make the difference. That's it. But we will help process the deeds, get them recorded. So somebody signs a purchase and sale agreement, wires us the money. We then process the deeds for their signature, get them on file in the county courthouse or courthouses. Once the stamped deeds come back, then we notify the oil and gas company. Again, copying the investor on all of these emails, so they're in the loop. Call the oil and gas company, say, hey, there's a new owner. What they then do is they freeze the monthly payments on that piece of the minerals. It doesn't go away. It goes into what's called a suspense account or a trust account. And while what they have to do is then they will have their staff of title attorneys go back into the courthouse documents and make sure that, yes, this is the new owner and this is the correct ownership percentage. Once they do that, they will release all of the monthly royalty payments from the suspense or trust account and start getting the new investor their monthly checks. That process at the oil and gas company can take anywhere from 90 days to 6 months, sometimes occasionally longer.
Okay.
And we are in touch with them all the time. We can't force their hand on how fast they move, but they typically will give us, it'll be about 60 days. They kind of let us know what they think when they think they'll be done.
Sure, exactly. And just to kind of go back a little bit, when we're talking about deeds, these are deeds in relation to which part of this stack? The topsoil, the mineral rights, what part of
mineral
this
rights?
Mineral rights.
Mineral rights.
Okay. Yeah. Just wanted to make sure, because I know a lot of people listening to this, at least that, come through for us are very familiar with, owning, the house that goes on top of all this. So when people
Right.
we're talking about this, we're talking about ownership of mineral rights, and that is, and to kind of go back to the very beginning, it's almost always going to be different than and what do you call that in your industry? What do you call like the very top of it? Topsoil, or what's kind of the general term?
Surface rights.
Surface rights. So the mineral rights being different from the surface rights, and that's kind of a whole other ordeal, because there is money, like you said, that can be made by owning surface rights on just kind of like the land leasing for where the well goes and stuff. But what we're talking about is the mineral rights, which is returns based on production of the extraction of those minerals that you own the rights to, correct?
Yes.
Okay, great. So, let's say someone's, kind of interested in this. What exactly is the process, besides just, coming to you? I mean, is there a fairly standardized contract process for purchasing these things? Is it something that's completely like diametrically opposed to purchasing surface rights? Walk us through kind of the 30,000 foot view of, someone saying, hey, this sounds interesting. What does the process look like for acquiring this kind of stuff?
So typically an investor says, I'm interested, our first question is going to be, okay, how much do you think you want to invest? 200, 300, 400,000, whatever it is. Could be 20 million. Doesn't matter to us. We've got plenty of assets. So let's say it's 200,000 bucks. Then we will go through our inventory and put together or find a deal that we've got that fits the 200,000 category. We put together the seller's check stubs so you can review them. At least see that, hey, these are real. They are being paid, right? We put a summary together of how many acres, how many wells, how old are their wells, a map of where they are, just some summary bullet points, because that to us in the oil and gas royalty space, that's like a realtor showing you a house or you're looking at a house on Zillow or something. Mm-hmm. We do that before they sign a contract to buy, so the investor kind of gets to shop. They don't last long. You can't take, a month to think about it, because it'll be gone. These things get gobbled up pretty quick. But they can also tell us, I'd like a mixture of oil and natural gas in terms of cash flow. That's easier said than done the higher the dollar amount, because at $100,000, there's not a lot of sellers that are really, really small that we might have to put 2 or 3 together to make the mixture of oil and gas. But however, having said that, there are some areas of the country where the wells produce both, so you get both automatically. Mm-hmm. So once we put that together, we send it over to the investor for their review. Certainly, we're here to answer questions. Then they say, okay, we want to buy this. Then we put the purchase and sale agreement together, which is it's standard language in the contract book. All the attorneys even copy each other. They all look the same. You sign that, you wire the funds, then we process the deed. It happens pretty quick.
Yeah, no, definitely makes sense. Can you still hear me?
Hello?
Yeah, can you hear me, Jim?
Alex?
One sec. Can you hear me? Or is the Jim, can you hear me?
Hello?
Hello?
I can hear you now.
Okay, great. Yeah. So you kind of cut off on, at the point of saying, hey, the deed gets recorded. So at that point, it's kind of where it cut off, and we'll edit this out a little bit. So,
yes.
Okay.
So from signing the purchase and sale agreement to getting the deed recorded, I mean, we're talking days, not weeks. That happens in a few days. We send it over to the investor. They sign it. Advanta, or they give the authority for Advanta to sign it because it's in their IRA. Then funds get wired. Once the funds are received, then we draw up the deed, send that back over for Advanta and the investor to sign. Then we get them back and process them at the courthouse and with the operator. Courthouses usually take a couple of days to get the stamp deed back to us, and then we can call the operator up.
Yeah, no,
it doesn't take long.
Yeah, I'm assuming, for places that are familiar with this, it's, they're all processing these kind of deeds in the same manner they're doing, for
every day.
service rights.
Yeah, they do it every day.
Yeah, gotcha. And then how long are these contracts written out for? There's stuff that has to be renegotiated later on down the road. Are these things that you negotiate them on a yearly basis, or is it like a 2-year, 5-year? How exactly does that kind of?
That's a really good question. So these are perpetual ownership. You own them until you say you want to sell them. That's why it's multi-generational cash flow. You can deed them down, will them down to your family. And we are, as far as us, the sellers coming to us are often second and third generation owners through estates. But, and I think it's important that we have the conversation about what to look out for.
Mm-hmm.
How can you get, hosed? Because you can't if you don't know what you're doing.
Absolutely.
So a couple of things that, whether you acquire this through us or somebody else, here's a couple of things you want to look for. One is you want to make sure that you're buying an asset that goes to all depths, to the core of the earth. Oftentimes they are severed by death. I shouldn't say often, but there are some that do this. You only own down to a certain depth. Well, that's great if there's one well at 5,000 and okay, you're getting that one, but the seller might say, well, I'm going to keep, or the broker usually does this, I'm going to keep everything below 5,000 feet. Well, that's not so good if all the other formations are below 5,000 feet. You don't get it. They drill a well 2 years from now at 7,000 feet, you get nothing. You don't want that. You want to own all depths. Another thing to look out for is you do not want what's called well bore only. So think of your 100-acre ranch that you're going to move to it from Florida and Texas, right? And they drilled 10 wells. If you wanted to buy if you bought the well bore only on, say, those 10 wells, and they drilled an 11th well, you don't get anything of the 11th well because you don't own the acreage. You only own the royalties off the actual well bores, the first 10. You don't want that either. Unless you want to play in the risky end of the swimming pool. And then
Gotcha.
there's going back to your original question with the timing, we know of a few people that have started putting terms on these royalties. They'll sell it to you for 10 years and then ownership reverts back to them. Well, that's not what you want either if you want a conservative, multi-generational cash flow asset. How much are you going to make in 10 years? Are you going to get all your investment back? That's the question. First question I would have.
Yeah, absolutely. So they're selling these things more on kind of like a long-term or perpetual lease type agreement rather than ownership. Is that kind of what I'm hearing?
It's not even perpetual lease. It's when you own the minerals, you own the rights to the oil and gas below the surface. You own it forever. If you have all depths and the minerals, which may or may not have in our case, they all have producing royalties on them. You own it until you don't own it, until you say, I want to sell it, which could be 5 generations from now.
Yeah, absolutely. And just, and I think that kind of covers a lot of the good stuff. I do have a few more specific questions that, may or may not really kind of play into this, kind of bring it in for a landing. But when we say minerals, let's say you bought, mineral rights on a certain piece of property, and then they found, let's say, coal or uranium or lithium or something else. Are these deeds scoped in the type of minerals that can be extracted? Or if you buy them, is it everything or does it vary? Maybe you can touch on that a little bit.
Yeah, it's everything, but I know for a fact there's coal royalties up in West Virginia, and I'm sure there is out west as well. That's not our wheelhouse. We don't see those. I would presume there's the mineral rights would apply to lithium or cobalt or copper, but I don't know if those are on federal lands, because if they're on federal lands, then the federal government is the mineral rights owner. Not you.
Yeah.
But I have no idea because it's just not our wheelhouse. But mineral rights in general would be whatever they pull out of the ground.
Yeah. And I kind of figured as much, but I'm assuming, they're just like with real estate, there's all sorts of different stuff that kind of goes into it. But that was just kind of one of those questions that popped into my mind that I figure I might ask. I got the expert on the call. Why not ask and see what he has to say? So, we're kind of coming up on about a half hour. This is where we like to cap them off. But I think it's been great information, Jim. I certainly have learned stuff. I always am trying to be a constant student of anything that has to do with investing. So thanks for bringing some great information today. If people are interested in getting a little bit more information on mineral rights, specifically with oil and gas, how can they get a hold of you, and what else do you have going on?
Sure. So they can contact me at Jim at H3NRG, that stands for Natural Resource Group, NRG.com, or they can call my cell at 704-907-1343. Those are the two easiest ways to reach me. What else do we have going on? We've got $20 to $30 million in deal flow every month. So we're constantly talking to investors and constantly seeing assets.
Fantastic. Well, again, thank you very much for being on with us today. This has been another edition of the Alternative Investing Advantage podcast. I'm your host, Alex Perney. Thank you for joining in today. And if you have any other questions or you'd like to get more information, you know how to get in touch with Jim, or if you'd like to get in touch with me, you can always call at 727-754-9954 or go to AdvantaIRA.com. Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at AdvantaIRA.com and subscribe.